The market is closed, and Plug Power Inc. completed its trading session on Thursday, June 18, 2026, with the closing price settling exactly at $2.85 per share at 4 p.m. EDT, marking a significant intraday surge of 7.55% as it climbed away from its previous baseline. While casual onlookers using their favorite online investing tools or scrolling through basic investing sites see this single-day jump as a clear sign of a structural turnaround, the true reality underlying this price action points toward a volatile tug-of-war between retail momentum and massive structural headwinds. This divergence between immediate optimism and technical reality creates an uncomfortable trap for regular retail investors who manage their individual brokerage accounts without checking the underlying fundamentals. The clean 20-cent gain on the day generated massive volume, with over 66 million shares changing hands, against a historical average daily volume that sits closer to 56 million shares. When you look across the retail brokerage ecosystem, whether you track user behavior on the Robinhood app, check popular forum discussions linked to Robinhood investments, or analyze the technical flow indicators on the Interactive Brokers trading desk, a specific narrative starts to form. The expectation among small investors utilizing self-investing platforms is that the bottom is finally in, and that the company is on the verge of validating its massive build-out of hydrogen production plants. However, the institutional reality reflected across sophisticated platforms like Fidelity Investments or premium Interactive Brokers account dashboards paints a drastically more cautious picture. Professional traders are treating this intraday spike as a classic short covering rally or a high beta reaction to broader macroeconomic shifts, rather than a genuine shift in corporate cash flow viability. To truly understand why the general consensus is likely misjudging the situation, we have to look closely at the stark contrast between market expectations and execution reality. The public narrative surrounding green hydrogen suggests that government support, combined with localized tax credits, will automatically guarantee the financial survival of early infrastructure players. But when you pull back the curtain on the actual financial metrics available to anyone using Fidelity Wealth Management services or analyzing corporate balance sheets via comprehensive intelligent portfolio tools, you find that the cost of revenue continues to outpace actual sales numbers. In the first quarter of 2026, the company generated around $163.51 million in revenue, while its cost of goods sold spiked significantly above that mark at $192.93 million, leading to an operating loss of over $103.93 million for the quarter. This brings us directly to the core problem that retail investors trading on the Robinhood stock trading platform often overlook, which is the sheer speed of cash burn relative to infrastructure scaling. The company has spent decades promising a transition from a pure technology seller to a vertically integrated energy producer, yet every single molecule of hydrogen distributed currently costs more to produce, transport, and validate than the market price allows. Many retail buyers who use simple investing sites look exclusively at the top-line potential, assuming that a larger production footprint will naturally yield economies of scale. The reality is that institutional capital, the kind that dictates long-term trends on the Interactive Brokers platform, has become highly skeptical of businesses that lose money on a gross margin basis. Let us dive deeper into the recent trading dynamics and sector momentum influencing this specific clean energy basket. The wider sector has experienced immense volatility over the last 12 months, with this stock swinging between a 52-week high of 4.58 and a depressing 52-week low of 1.03. When a stock trades under the $3 threshold, it becomes a playground for high-frequency algorithms and speculative options traders who utilize active platforms like SoFi Invest or specialized online investment tools to capture quick percentage swings. The massive volume we witnessed during the last trading session indicates that short sellers were likely forced to cover their positions as the stock crossed key technical moving averages, which artificially accelerated the upward momentum. Comment below how many shares of Plug Power you currently hold in your portfolio and whether you are buying more at these levels. Hearing from people actively navigating this volatility provides an excellent window into current retail sentiment. If you look at the macro environment, the cost of capital remains a massive bottleneck for capitally intense clean energy firms. In an environment where interest rates stay sticky, borrowing to fund massive infrastructure projects becomes incredibly prohibitive. For a company that reported a massive net loss of $245.3 million for the March 2026 quarter alone, relying on external financing is no longer an optional strategy. It is an ongoing survival mechanism. This reality has forced management to repeatedly utilize at-the-market equity offerings, diluting existing shareholders to keep the lights on and to fund their massive capital expenditure requirements. This continuous dilution explains why the stock has lost vast chunks of its valuation over a multi-year horizon, despite occasional multi-day retail rallies. To ground this entire dynamic, we need to take a step back and look at what this business actually does and how its core operational structure functions. The company built its initial reputation by deploying hydrogen fuel cell systems to replace conventional batteries in electric lift trucks and material handling equipment used within large-scale distribution centers. Over time, it expanded its ambitions to include the entire hydrogen ecosystem, encompassing the design and manufacture of advanced electrolyzers that split water into hydrogen and oxygen, the build-out of liquid hydrogen generation plants, and the development of cryogenic storage and delivery logistics. While this end-to-end model sounds incredibly comprehensive on paper, the operational execution has been plagued by chronic delays, high construction costs, and localized supply chain disruptions that prevent the business from hitting its self-imposed targets. Historically, the company has heavily relied on a handful of massive retail and logistics giants to anchor its commercial fuel cell deployments, which creates a dangerous level of customer concentration risk. When these anchor customers slow down their capital expenditures or opt to test competing battery configurations, the revenue pipeline suffers immediate stress. Furthermore, past financial reports show a consistent pattern where manufacturing inefficiencies and unexpected maintenance costs on deployed units completely erase any incremental revenue gains. This mismatch between ambitious forward-looking guidance and lagging operational reality has created a deep sense of fatigue among institutional asset managers who allocate capital through major fidelity ETFs or long-term fidelity mutual funds. Looking forward, the trajectory of this stock will depend entirely on how reality resolves its ongoing conflict with market expectations. In a bullish scenario, the company successfully secures non-diluted government backstops or forms massive strategic joint ventures with global energy conglomerates that possess the deep pockets needed to absorb early-stage operational losses. If these catalysts materialize, the current short interest could trigger a massive squeeze, sending the stock back toward its previous highs as retail traders crowd into the Robinhood app to chase the upward momentum. Such a move would delight momentum strategies deployed across active trading networks like SoFi Active Investing. Conversely, the bearish scenario is rooted in the hard math of the balance sheet. If the operational cash burn rate remains close to $200 million per quarter without a corresponding structural improvement in gross margins, the company will be forced to execute further dilutive equity raises or restructure its high-interest debt components. This outcome would likely break the psychological support levels established near the recent lows, dragging the stock back toward the dollar mark and alienating the remaining cohort of self-investing enthusiasts. For investors tracking their portfolios through an advanced intelligent portfolio framework or evaluating risk metrics via an interactive broker's account, the lack of visibility regarding positive cash flow remains the ultimate red flag. When you weigh these two distinct paths, the overarching lesson is that short-term price action rarely reflects structural corporate health. The 7.55% jump to $2.85 is an exciting technical event for day traders operating on modern trading platforms, but it does little to solve the systemic challenges of building an entirely new energy infrastructure from scratch on a negative gross margin. True clarity in individual brokerage management requires looking past the daily green candles and focusing intensely on whether the cost to produce a kilogram of hydrogen is actually dropping faster than the market price of that fuel. In summary, the central tension dictating this company's market value lies between the hope of an integrated hydrogen ecosystem and the harsh financial reality of an ongoing infrastructure cash drain. While short-term retail buying and short covering can easily drive sharp intraday movements, long-term sustainability requires a fundamental shift toward profitability that has yet to show up in the quarterly filings. Managing this risk requires an objective, clear-eyed view of corporate cash generation, ensuring that you separate temporary market noise from real structural execution. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bask, Bosk. Don't forget to like, comment, and share this video to support the channel. Heart.